And they'd say, and we estimate what this will do is it'll reduce headline inflation by X amount. Every single one of those changes had the effect of lowering the headline inflation. None of the revised numbers increased the CPI. And aggregated over time, we're not, right now, we're looking at something like 8.2 percentage points that have been have been subtracted annually from the headline CPI. So that if you're looking at a cost of living adjustment on Social Security today, which is up 2.8% or something, whatever the year over year CPI was, it should have been closer to 10%.
Welcome back to Metals and Miners. I'm your host, Gary Bohm, and today we're pulling back the curtain on the real state of the U.S. economy. Behind the headlines, the numbers tell a very different story, and no one has tracked that story more closely than today's guest. I'm honored to welcome John Williams, founder of shadowstats.com, where for decades he's been recalculating key government economic data like inflation, unemployment, and GDP using methodologies that the United States used to rely on before statistical distortions became the norm. John's become a go-to source for those who want the unvarnished and untainted truth about the economic reality and what it means for markets, policy, and your wallet. John, welcome to Metals and Miners.
Gary, thank you so much for having me on your show.
Yeah. All right, John, your shadow stats inflation estimates often diverge significantly from official CPI figures. Could you elaborate on the key methodological differences and why you believe that your approach provides a more accurate reflection of real-world inflation?
Sure. Well, the calculation of the Consumer Price Index, which is the government's headline inflation number, and it's the number that's used to adjust people's Social Security payments and such. The calculation of that goes way back in time, I think back to the 30s, I guess, in terms of estimations. But come the early 1980s, there was a shock to the system where the headline inflation came in much higher than expected. And Newt Gingrich, who was then the speaker, he called in the head of the Bureau of Labor Statistics, Catherine Abrams, and it said, hey, the CPI here is running a lot higher than we expected, and it means we're not going to have as much deficit spending that we'd like to do for next year. You could find a way to alter effectively what he says, you can find a way of altering the reporting of the CPI to make it lower. We might be able to find more money for the Bureau of Labor Statistics. Well, the Bureau of Labor Statistics changed the way it calculated the CPI, and presumably they got more money. Very specifically what they did, and this was up through 1980, but 1980 and before is basically consistent over time. But what they did to help the Congress here was they redefined the Consumer Price Index. The component involved was the cost of owning a home. Used to have a component there, cost of owning a home in the CPI. And rather than having the cost of owning a home, they redefined it to a new feature was referred to as a homeowner's equivalent rent. And what they did was they redefined what would a homeowner pay himself to rent his own house to himself, and then how much would he raise it on himself each year, and a couple of other gimmicks like that. And the effect was just changing that one definition knocked 1.5 percentage point off the annual CPI. And after that, they just went on, and there've been about 20 to 30 changes, not all of which have been reported by the Bureau of Labor Statistics, but my hat's off to them in that when they make a change, they document it. They say, here's what we're changing. Here's how it's going to affect the CPI. What I did, and I took great offense at this because anyone who was on Social Security had bought the concept that he or she would have income adjusted for inflation, as honest inflation, as it went along. And these numbers, they not only did they make that one change, but they made changes after that. And but each time they did it, they would detail what they did, and they'd say, and we estimate what this will do is it'll reduce headline inflation by X amount. Every single one of those changes had the effect of lowering the headline inflation. None of the revised numbers increased the CPI. And aggregated over time, right now, we're looking at something like 8.2 percentage points that have been have been subtracted annually from the headline CPI. So that if you're looking at a cost of living adjustment on Social Security today, which is up 2.8% or something, whatever the year-over-year CPI was, it should have been closer to 10%. And people on Social Security have not been getting the income adjustments for actual inflation as they thought they had been set up. At least if you were functioning back in those days, as I was.
So that money has been pulled away from the Social Security recipients. It's lowered headline CPI, which has also impacted, the budget deficit, because
Sure.
otherwise the budget deficit would have been blown out that much further.
Yeah, it is. But where the Bureau of Labor Statistics has been good enough to at least estimate the impact, what I have done and what I started to do 20 years ago, 40 plus years ago, is to take their estimates of what they have taken out of the CPI and added that back in. And that's so I publish an estimate of the CPI the way it would be had they not made all these adjustments. Now, coming up to the pandemic, all those changes have been in place. During the pandemic, they did some unusual things which I've not written about yet, and I've not adjusted for. I mean, I'll adjust for it as they post it and make their estimates on it. What they did was they used moving averages in inflation during the pandemic from including prior years to sort of bring down the headline inflation that was very unstable. The pandemic was an unusual time. So we'll see how that works. But based on the changes that they'd made up to the pre-pandemic, again, you're looking up at that, a plus percentage point shortfall in the headline CPI.
So essentially for 43 years plus now and counting, they keep adding new gimmicks in order to dampen down headline CPI to make it look like everything is stable, but the resulting impacts are we still feel the actual reality, even though we're being told something different. And then on top of that, seniors and others who would qualify for Social Security benefits are really not receiving full payments.
That's correct.
Yeah. All right. So based on true inflation calculations right now, where do you see inflation going over the next, well, we'll just say through the end of 2025?
Well, it's right now we're looking at something over up in the the 10% range. It's probably going to stay close to that as we go through the end of the year.
Okay.
But it again, there are indications here confirming my numbers, and there are ways of for the individual to effectively hedge against what the government's doing.
Yeah, and I do have some questions about the hedging a little bit later. let's talk about your chart. You sent me a chart, John, that I'm going to go ahead and pull up now. And can you see that?
Yes, I can.
All right, wonderful. So your chart shows that there's a stark divergence between ShadowStats alternative or alternate CPI and official CPI figures since 1980. And gold prices are more closely tracking your estimates. How do you interpret the relationship between inflation, both official and shadow stats, and gold prices? And what does this suggest about gold's role as an inflation hedge in today's economic environment? And then if there's anything else you want to share about the chart, please do.
Well, basically, gold is a hedge, and it traditionally has been a hedge against inflation. It retains its real value over time, adjusted for headline inflation. And if you look at the chart, um, the what becomes the bottom line as you get into the current period, that's the headline CPI, and up to the point in 1980 when they started playing around with understating the CPI. The CPI and the gold price pretty much moved together. The line that starts going higher, which is the blue line. That's smooth blue line. That is my estimate of the CPI as it would have been had they continued to report it the way it had been. I mean, they reported it consistently, and it's effectively become exponential.
Yeah, it
But
has.
but if you look at the red line, which is the gold price, which is independent, I mean this is from the free market. Um,
The green line is the gold price.
okay,
The red is the CPI. Yeah.
okay. Well, my eyesight is poor here. The lower line that goes off to the right is the headline CPI. The smooth line that goes vertical is my alternate CPI, and um, the one that's a little rough on the way going up, that's that's the gold price.
Okay.
So what you'll see is that right now the gold price and the alternate CPI, the way it used to be calculated, pretty much are still moving together.
Yeah, they are.
Gold is a great inflation hedge, and it's an actual inflation hedge. It works. It works with what the old series was. And when you see the gimmicks come into the reporting, all of a sudden you'll see there's a big divergence um, between the gold and the headline CPI. The gold is more volatile here, but it is there are other factors affecting it, but basically underlying everything, it's a store of wealth, and it stays even with the inflation over time.
Yeah, it's remarkable. And the divergence that you can see here between shadow stats, you know, inflation and CPI reported inflation since 1980 is astounding when you see it charted like this.
It is, and it's a benefit of exponential uh,
So
growth,
what's to
or
stop?
lack of exponential growth, which you no longer see.
Right. So what's to stop this trend from continuing this exponential, disparity and it just going off the page? What both actual inflation as well as the price of gold. What's going to stop this from continuing this trend?
Well, as long as they keep playing the games with the inflation, you're not getting honest reporting on the inflation. The gold is reflective of maintaining a constant value of wealth over time. It's your basic inflation hedge. Um, so I mean, as long as they're playing the games here, you'll find the two will tend to track with each other. And if you're seeing higher inflation, what you're seeing here, the rise in the price of gold largely reflects the debasement of the U.S. dollar in inflation terms, in terms of its ability, its purchasing power in real terms, net of inflation. So that it's not that gold is soaring so much as it is maintaining its real value. It's the dollar that's falling apart and depreciating here. The purchasing power of the headline CPI is just way is nonsense.
So I'm assuming, based on what you're saying, is you're anticipating this trend to continue unabated, and depending on things moving forward, it could even increase.
It could. I mean, if the government decided to change its CPI around, they could bring everything back into line, but I don't think that's going to happen.
Okay. All right. So let me get off this chart for a moment and come back to us here. And John, surveys are showing right now that households are expecting 5 to 10% inflation moving forward. But that's far above the Federal Reserve's 2% target, and it's far above headline CPI that has been reported. Why do you think public perceptions align more closely with shadow stats estimates than the official numbers that we're hearing or the targets that the Federal Reserve is putting out there?
Because the average guy has a pretty good sense that they're not realistic. I have people who are using my index to landlords that are using it to adjust rents on their rental properties. They say I can't live with it. I can't live adjusting my rents using the headline CPI. It's nonsense. There's a fair sense of something's not quite right there.
Yeah. All right. So recent studies, such as the one from the Federal Reserve Bank of Boston, suggest that tariffs could add between 0.5% and 2.2 percentage points to core PCE inflation. How do you assess the impact of the current tariff regime on actual inflation? Do you expect them to be inflationary, or do you expect them to be deflationary?
I think they tend to be inflationary. It's you get some balance there with the way the economy adjusts to that. But tariffs by their nature are inflationary. I mean, it's boosting the cost of the imported product.
Do you expect the tariffs to reshape consumer and business spending moving forward?
Let me put it this way. My family business was imported the steel chainsaw from West Germany, later Germany, and we, at least in the time we were involved with it, we blew apart our domestic competition because we had a very high quality product for a good price. That doesn't change too much. If you have if you have something that people will buy, and it's and you've got it within a reasonable price, they'll continue to buy it, and to the extent that it's coming from outside the system, it tends to actually it's a negative to the economy, because the size of the trade deficit is a negative to the economy. It does affect inflation, actual inflation, but again, generally that's not reported much in the headline CPI. So that I see the general trend continuing here, where the actual inflation is going to continue to surge above even if they don't make any further changes to the system, to surge against the headline CPI. If they tried to bring it back into shape, you'd find the headline CPI would be rising, and that might bring things back into a little better shape. But nobody wants to show that they're responsible for higher inflation.
And higher inflation, do you see higher inflation increasing the probability of a recession in the near term? Are you in the recession camp sometime in 25 or early 26, or are you not in the recession camp?
We're in a recession, and it's not. I mean, I just had a subscriber write to me, what are you talking about? We're in a recession, and things are just booming along. The GDP is, you look at it year over year, is up something like 3.5 percentage points. That's adjusted for inflation. The GDP is, let me put it this way: the consumer price index is not the only government statistic that gets played with a little bit, and the GDP is one that is it's got a lot of guesstimation in it by the government. It is, if you look at the GDP, headline GDP, this is adjusted for inflation. Year over year change, it's up about 3.5 percentage points, which that's average growth. That's not a recession. Yet the GDP, the gross domestic product, the total economy, includes such things as retail sales, industrial production. You look at the major components of it. You look at retail sales adjusted for the government's headline CPI, not my CPI, just the headline CPI, the headline real retail sales. Negative year over year, flat to negative year over year. You see the same thing with industrial production. You look at the housing, real numbers, government real numbers, flat year over year. The underlying economy is not showing that 3.5% growth that the GDP is showing. And where that gets gimmicked is in other areas, but the inflation that's used there, the implicit price deflator, is a factor in the way the real GDP gets reported. The real GDP is a nonsense number. I mean, that's pure politics. It has nothing to do with underlying reality, at least at this point in time. There were times when it was meaningful. It's been a while.
Okay, so you see us as currently being in a recession. Let me ask it this way: do you expect some level or a great level of economic deterioration from here?
Well, we've already had it. It's the deterioration has been in place.
Do you
It's
expect
probably going to continue
further? Yeah, it'll
Yes,
continue.
I do expect further, and there are some elements that do reflect the underlying reality. One of the best ones is the consumer sentiment is published by the University of Michigan.
Mm-hmm.
That's continued to sink. It has never recovered its pre-pandemic level. I mean, the way the economic cycles get reported, you have the growth in the CPI, then if it turns negative, you hit a trough. It's negative for 2 quarters. That's a recession. Hits a trough and it starts growing again. Then you recover. You get the growth back above zero. The consumer sentiment has never recovered from pre-pandemic levels, and what happened here? It's interesting. I mean, this is separate from my work. The National Bureau of Economic Research is the defining authority of U.S. recessions, and that they couldn't understand why consumer sentiment, which is such a good indicator of underlying economic activity, it's an honest, privately published number, why it had not recovered along with the economy. It always recovers along with the economy, and they looked into it. And what they concluded was that because of changes that were made to the CPI reporting back in 1980, that the inflation was a lot worse than being reported, what you see with my numbers, and that this was depressing actual experience for people being surveyed and for consumer sentiment. And the nice thing about consumer sentiment, people are just asked, how are you doing? They're not. If you ask someone, how's the economy doing, and they've been listening to the news and the GDP's up 3%, they'll say, oh, it's bumming along, 3%. How are you doing? Well, I'm out of work and my income's falling. you get different answers.
Yeah.
And then the beauty of what the National Bureau of Economic Research is, it asks people how they're doing. And the average guy is not doing well. He's never seen a recovery from pre-pandemic levels.
Yeah. Okay. So, John, in every recessionary part of the business cycle, unemployment spikes, and the average spike is about 3.6%.
Mm-hmm.
We're down, we started in the, mid to upper threes in this cycle, and now we're moving upward. We're in the low four somewhere. Are you expecting a 3.6 total percent unemployment spike before this end of this business cycle, which would put us, in the 7.5 to 8% range? Are you expecting something greater? What are you expecting for unemployment?
Well, the employment unemployment numbers are not particularly of a particularly good quality. If you read the reports, maybe to look at the January reports each year, they make the revisions to prior history. They'll state that reporting here is not consistent with the prior historic reporting. I publish an alternative measure of unemployment, and this is in terms of a broad unemployment measure. The government headline unemployment, if you're out of work and actively looking for work, they'll count you as unemployed. If you find that you can't get a job and you stop looking, then you become a discouraged worker. In the way to define it, and they'll count you as a discouraged worker for 6 months. And if you're discouraged for more than 6 months, they don't count you anymore. I estimate that I still count the discouraged workers. Someone says, I want to work, but I can't find a job. I get an unemployment rate up over 20% right now. People who'd like to want a job, but I can't find it. But they're not most of those are not counted because they've given up looking for work. Now, that doesn't mean they're not, trying to sense where things are in their own market. But
That's
it's
outrageous.
It's a difference in definition. The headline numbers that they will count you for a brief period, but that's not the headline. The headline unemployment does not include the discouraged workers. That's what they call the U6 measure. The U3 measure, which is the headline number, there you're actively employed. You're actively looking for work. You're not discouraged. You haven't given up looking for work because there are no jobs to be had. And that's that. If you're in that category, they count you for 6 months.
Okay. And so your number's closer to 20%. I'm assuming over the last, say, 12 months, maybe a little longer, you've been seeing that number rise. How much higher are you anticipating this number to rise before it plateaus and maybe starts coming down again?
Well, it's still increasing. You need to see a stable economy, and we're not seeing it again. If retail sales adjusted for the government's understated inflation, and you have to keep in mind now that if you use understated inflation with to come up with the inflation, that's a definition for the inflation adjusted number, you're overstating the growth. The inflation's understated. It is understated. We're not seeing any let up here.
Yeah.
It's one reason that the Biden administration lost. I'm not playing politics here. I'm telling you that if you want to predict the outcome of a presidential race, you look at the incumbent party and look at the hard numbers, like the real unemployment rate, and if they're bad, the people will vote their pocketbooks more often than not. You'll tend to have a vote against the incumbent party. Trump, the first time around, was killed by the pandemic. The Biden administration, there are other issues involved, of course, but What we're seeing here is that although the Biden administration, I'll give them this credit, they did actually do something to boost the GDP numbers that had some underlying reality. Most of the time, they're playing number gimmicks. The administrations, but they did what they did was they depleted gasoline reserves, the strategic petroleum reserve, which had the effect of reducing gasoline prices before the election, not this current one, but the one before, and so that did help the average guy, and they were reelected, but the Trump lost. Trump lost with the pandemic. The
And then Biden did the
Biden
SBR drain, and that helped
that helps, and
during
then
the
but
midterms.
now
Yeah.
but what happened this last time around is that we've been seeing things weaken, and where the Biden administration did make positive changes in terms of the numbers. I mean, I'm not talking about the long term stuff, but they actually did change elements of the economy. Most recently, you haven't seen the hard developments there. It's more puff
Yeah.
than anything else.
Yeah. All right. So let's talk about the US dollar, John. A weaker US dollar has often been cited as an objective by President Trump. We haven't heard him actually come out and say he wants a weaker dollar, but we have heard many that are saying that that's actually what he wants. Get the dollar down is what we hear a lot. Based on your shadow stats metrics, historical analysis, how do you see a potential weakening of the US dollar impacting, inflation, gold, economic growth?
Weaker dollar gives you stronger inflation and a higher gold price. I mean, if you're seeing a weaker dollar, it's being depreciated in terms of its purchasing value, purchasing power. That's the same thing as rising inflation. The very important factor in terms of gold prices, that's driven by inflation. In terms of the currencies, relative currency strength is often determined by relative inflation and relative economic growth. Countries with the lowest inflation tend to have the strongest currencies.
Are you expecting, the Dixie, I think, is trading, we'll say 100, 101. It's down from about 109. Some are saying that we could see it drop into the low 90s, maybe even further. Do you expect that?
In terms of the FTSE?
The Dixie, the DXY?
Oh, the Dixie. I'm sorry, the term
the dollar.
The abbreviation. I'm not.
I'm sorry, the dollar index.
The dollar index. Okay, yeah, it's there's nothing being done here to strengthen the dollar, so I think you'll continue to see ongoing dollar weakness.
So dollar weakness. So you expect then to see because of that, higher inflation, higher gold prices,
yes,
et cetera. Yeah. Okay. All right. So, are there any ways that you're currently recommending to your, folks who are subscribing to your services to best protect themselves against what you've long been warning has been negative economic and inflation circumstances, economic contraction, surging inflation, et cetera? Are you recommending any ways to protect against that?
Well, the key thing to protect against here is the inflation. That's the debasement of your currency. If you own a house, your house is the real estate will tend to rise with the inflation. But you don't necessarily want to sell your house. There may be some liquidity issues. The primary hedge I look in terms of offsetting the inflation or protecting against inflation is holding physical gold. It's worked over time, and it's historically it is the best, and it's a very proven method of maintaining the purchasing power of your currency. This the U.S. dollar is not the first one to be debased by its government.
Right.
And over time,
they all seem to do it.
Over time, inflation wins out in devaluing a currency against on a relative basis. I mean, if all currencies are inflating at the same pace, you're still going to have higher gold prices. It's purchasing the purchasing power of the currency,
right,
is maintained by the relative price of gold. That's been
okay,
established over time, and it continues.
yeah. All right. Well, look, I want to welcome everyone who's tuning in to this fantastic interview with John Williams, founder of shadowstats.com. It's been an incredible discussion. Before we wrap up here, I just want to direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join the quickly growing community and receive a free report that's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio in the title of that report. Consider upgrading for access to premium content, but even without premium, there's plenty of free content daily. So visit metalsandminers.substack.com to join us and explore. And thanks for watching this interview. Now, I'm positive that you've been enjoying the conversation that John and I have been having as much as I have. Please let him know, hit that like and subscribe button, and leave a comment below the video. John, would you please share a key takeaway that you want viewers to keep in mind about today's economic market and monetary situation that everyone's experiencing, and then let everyone know where they can learn more about your work and how they can connect with you?
Well, primarily, the best hedge that you can make right now in this current circumstance, and is often the case over time, is holding physical gold. That will give you long-term protection on an inflation basis, and a lot of, I mean, we can have political turmoil as well. Holding the physical gold, as I see it, is your best bet. I'd be happy to get into this with anyone. I do publish a newsletter called The Street Shooter, and anyone's interested in subscribing or getting information on that, you can reach me at John Williams at shadowstats.com. Send me an email. I also welcome telephone calls. I'm happy to talk to people on the phone about what's happening. My phone number is 707-763-5768.
And then you also have shadowstats.com, right?
Shadowstats.com is my website, but and it gives you 20 years worth of history. I've been doing this for a while, and it's got a lot of material. The problem is that it was a very fancily designed website 20 years ago, and our web host of 20 years went out of business with little notice. And I tried to relocate the site to a new website, and our programming's antiquated, doesn't work too well. So I've left we go to www.shadowstats.com. You get 20 years worth of history, get a lot of background explanation of how our CPI numbers work. All that's available to you, but for subscribers, and rather than getting the commentaries off the site, which you used to, and you can see 20 years worth of commentaries on the site, I currently send emails to subscribers with subscriber-only links to the latest commentaries and the alternate data files. I give people alternate measures of the CPI. Again, people are using that to measure out where they really are. Some people are using it to charge for rent and another cost. We also have an alternate unemployment rate, which takes out some of the gimmicking. And we also have an alternate GDP measure, which gives you the GDP net of terrible inflation gimmicks that you're seeing. That's probably the worst quality number that's published, the GDP. But all those the key data are looked at. Also, the money supply. The money supply is It's a straightforward number put out by the Federal Reserve. It has significant implications for inflation. We look at it in ways in terms of consistent series over time. We use the Federal Reserve's numbers, but what you're seeing right now is still an inflationary environment. You have what the Fed did during the pandemic was to significantly increase liquidity. Quick example: when the pandemic hit in February, March of 2020, the Fed pumped 35 years worth of monetary stimulus into the system. It's still there, and what you're seeing is that the liquidity is at a 40-year high, and that's what's driving inflation. You may not be seeing it all reported yet by the Bureau of Labor Statistics, but it's there. You're feeling it in your pocketbooks. It's you're not crazy. You're actually experiencing that.
Right.
Well, I'm always happy to talk about this and give you details. John Williams, shadowstats.com.
Wonderful. Okay, so I will have all of that information up on the screen for the viewers. I will also put it in the description area as click through so folks can click right through to you. And everybody just needs to go follow John. John has he's a wealth of information. He's trying to break through the facade of the fake data for us. And this is the information that we really need. So, John, I look forward to having you back on sometime soon. I really appreciate you being here with us. Everybody else, thank you for watching.
Thank you for having me.
All right. Well, look, I want to welcome everyone who's tuning in to this fantastic interview with John Williams, founder of shadowstats.com. It's been an incredible discussion. Before we wrap up here, I just want to direct everyone interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join the quickly growing community and receive a free report that's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio in the title of that report.